Welcome to Hedge Fund Tips with Tom Hayes for the week ending October 2nd, 2020. This is videocast episode 50 and podcast episode 40. So welcome today. We're going to kick it off quickly as we do each week with the media spots where we cover a lot of information in a very short period of time. First, I'd like to thank Ellie Terrett and Cheryl Cassoni and Liz Clayman for having me on the Clayman Countdown on Monday. And what we covered in this section was, in this segment was the jobs report coming up, which we saw today. I had said that, it would likely be higher than expectations, but most importantly that we would see potentially the unemployment rate slip below 8%. The consensus expectations were 8.2% down from 8.4%, and I thought we might get a 7 handle, and sure enough, we did. And if you talked to people just a couple months ago about, maybe 3-4 months ago, about being at sub 8% unemployment, no one would have believed it. And sure enough, this morning, it happened. So that was really good news to see. And the second thing that we talked about on the segment with Cheryl was the debate and election was coming up, and what would be the implications of that. And basically, the core implication that's at stake as it relates to the stock market, not related to social policy and other things that are of importance, but for this podcast, we deal with the stock market, was if you got a Democratic sweep, where you'd have the executive branch, the Senate, and the House all Democrat, then you would have affected the Democratic tax plan, which is two-pronged. Number one, it's to increase the corporate tax rate from 21 to 28%, which would take 2021 earnings estimates down from 170 down to 150. David Kostin had put out a note a few weeks back to that effect. So when you reduce earnings by that magnitude, in this case $20 on the S&P 500, you're going to have an impact to the pricing of the stock market. So as earnings come down, the stock market comes down, but there's also the factor of the multiple applied to those earnings. So right now we're trading about 20 times. If you brought earnings down that quickly, that multiple would likely contract because it would be anticipating slower growth. So you'd not only get the drop in earnings, but you'd get a drop in multiple, which could potentially lead to a re-rating of about 18 to 25%, a lower value in the general indices, number one. And number two is the long-term capital gains in the Democratic tax plan is to increase it from 20% to, that's X the healthcare tax, 20% to 39.6%. In other words, tax it as ordinary income. So if you did see a blue sweep, you would see a race to the exits before year end, a lot of selling of stocks to lock in the lower tax rate, particularly in those stocks, and everyone knows the concentrated handful of stocks, FANG Plus, that have had big runs. You'd see a lot of aggressive selling in those. So that's the bad news. The good news is the probability of a sweep is lower than it was in August. So regardless of whether you get a Republican president or a Democratic president, the key is you want to see either the Senate or the House, the other party. That means nothing changes in the tax rate. And if nothing changes in the tax rate, regardless of who's elected, that's very, very bullish for the stock market. So that's what we're looking at just in terms of the math of it on a stock market basis. And as I've said on a few spots, gridlock is good. So the second spot that I want to cover, and we're going to talk about the president. Obviously, that's major, major news today. So I didn't forget, and that's a very serious matter, and we're going to address that. Want to cover on Tuesday, I was on with Brad Smith on Cheddar. By the way, thanks again to Ellie Terrett, Cheryl Cassoni, and Liz Clayman for having me on Monday on Fox Business. Now on to Cheddar on Tuesday, Cheddar TV with Brad Smith. And I want to thank not only Brad Smith, but Francesca Conti for having me on. And what we talked about, we were following up on a long-standing conversation I've had with Brad. I was on September 1st when I was talking about the most loved and most hated stock in the S&P 500. And I was saying at that point, Apple was overvalued, trading at 39 times current year, 33 times forward at that time. And the highest multiple it had traded at in the last 15 years was 26 times, and the average was in the mid-teens. So I thought it was overdone, and literally to the day it sold off, and it's been under pressure ever since. And what we were talking about is that the reopening trade has really begun to work in September, and that industrials, materials, transports, financials have all outperformed tech in the month of September, reversing the trend. And the market is really sniffing out that we're going to be reopening. And you see the recovery numbers in China are about 3 months ahead of us because their peak cases was about 3 months ahead of us. And they're just beating expectations, and they're getting back to life. You know, you're seeing their movie theaters are open. I believe 80% at this point of their movie theaters are open. Their domestic air travel was 86% of pre-pandemics in August. It looks to be closer to 100% domestic in September. And there's no vaccine or there's no magic treatment. People just wear the mask. They do their best. They get back to their life and they move on. And that's what we're doing here in the United States. However, we did have some breakthroughs in terms of treatment, which we'll also discuss today. One of which relates to the president, which is also really helpful. The other thing that we were talking about with Brad was that this outperformance of cyclicals and value over tech and growth in the month of September, the beginning of this trend, the reopening trade, was also confirmed by earnings expectations for 2021, in which case you're going to see the sectors that are going to outperform the S&P 500. Our S&P 500 is going to grow at about 26%. Industrials are going to grow at 87.4%. Materials at about 30%. Financials at about 30%. And also consumer discretionary at 74.4%, which was consistent with the consumer confidence number that came out earlier this week that crushed expectations at 101.8, and today we saw the consumer sentiment number, which we'll cover later, which also beat expectations. So just as was the case of China, had their first positive print for the consumer in August after many months of industrial production and construction being very strong. And as I'd said in previous shows, that the consumer was the lagging indicator and that would come about. It came about in China. It's now coming about in the US. The consumer is coming back. And, you know, it's not that people are ignoring the risks. I think they're just better at dealing with it. We know when we go out into public places, indoors, we got to wear masks and social distance when we can and, you know, do all the protocols. And if you do that, your odds are going to go down. And then when you do get it, the odds of having a really bad outcome have really diminished with the treatments that are available and the doctor's knowledge just from experience. So, and that also contrasts. So while we just covered 5 sectors that are going to dramatically outperform the S&P in terms of 26% earnings growth, more than 26% earnings growth, tech is going to grow at about half the earnings growth rate at just 13.7% in 2021. And that's why we've been pounding the table for the last couple of months that to start to get exposure to cyclicals and lean into the reopening trade. And the trigger was going to be the vaccine. And that's really what we saw. The other thing that we discussed is that housing has led us out of every single recession post-World War II, with the exception of 2008 and 2009. And why was that? Because 2008 and 2009, housing was the problem. So you don't often solve the problem with the same problem. And so what we're seeing is a combination of multi-decade low inventories, dramatically high demand from 85 million millennials who are now average age 30 and starting housing formation, which was a trend that was beginning before COVID. It's dramatically accelerated since COVID. You've got sub 3% mortgage rates. You have the urban exodus rather, and all of that is a positive. So that was the key thing with Brad, and it's always fun to be on with Brad Smith on Cheddar. And thanks to Francesca Conti for inviting me on. Want to thank Sarah Smith and Kristen Myers for having me on Yahoo Finance on Wednesday. And what we really went into detail on Wednesday was one, the ADP report was out. And one of the things I wanted to highlight with that was that the expectation beat materially with 749,000 added payrolls relative to 650,000 estimate and 481,000 in the previous print. But what was very interesting was that you added a lot of jobs in the heartland. You added 7,000 jobs in mining, 60,000 jobs in construction, and 130,000 in manufacturing. That was key. And we saw that. And the other thing that I said to Kristen was, don't be surprised on Friday, although very few people are looking for it, if we get a 7 handle in front of the unemployment rate. And sure enough, we did. The payroll additions were a little light this morning, but the unemployment rate coming down was a major positive. And the most important thing, on Thursday, we saw continuing claims continue to come down. So that's critically important. The other factor, the key thing that we covered, you saw Chicago PMIs beat, so that's manufacturing was huge. We saw more prints like that today, which we'll cover later. Pending home sales up 8.8%. And the information vacuum. So, there was this back and forth on Wednesday, which has persisted through the end of the week, of what will happen, stimulus, no stimulus, etc. And I've been of the position, and those of you who listened last week, I thought it was low probability to get a stimulus package agreed to, and that still somewhat appears to be the case, although there was some positive rhetoric this afternoon back and forth, and the market was trading back and forth on Nancy Pelosi and maybe the President Trump coming down with COVID will change the dynamic in some way. We'll find out over the weekend. But my base case has always been that they wouldn't come to an agreement before the election, that they were running down the clock, and that more likely the president would have to do a second executive order, which has a couple hundred years of precedence, that once the money is allocated from Congress, he has vast discretion in how it can be spent. There's $380 billion sitting on the table, and that would be more than enough to potentially get a second stimulus package out, maybe with lower income thresholds, a stimulus check rather, extend the enhanced unemployment for those who are most at need, because by and large, the general economy, small businesses definitely need some help, but it's not a make or break for the V-shaped recovery for us to get another stimulus package. It is make or break for 5 or 10 million people who desperately need it, and they ought to do that because these people's livelihoods were taken away without their consent. The businesses they worked for were closed down, or their own businesses were closed down on the mandate of the government, and they need to be made whole. And this is the kind of thing that needs to be done. So hopefully they'll get it done this weekend. If not, by Monday, I would not be surprised to see President Trump issue an executive order. And that's something that really few people are talking about as an option. And I think it's positive either way. Ideally, they come to the middle. I think the Republicans are at 1.6 now, and the Democrats are 2.2. If they can't get to the middle of that, they should all be fired. End of story. But and then the last thing that Kristen was asking me about was the information vacuum. Why are you've had this constant back and forth of uncertainty in the market all September. And basically, I was saying we need to fill up the vacuum. It consists of 4 different parts. The more information on the vaccine. We've got 4 in phase 3. We had a new breakthrough treatment on Tuesday, which was the Regeneron monoclonal antibodies that had a phase 1 test of 275 patients. It took the duration of the symptom period from 13 days down to 6 days. So patients who took this cocktail, antibiotic cocktail of people who had COVID before, and then also I think Regeneron manufactures another antibody. At least that's the case in the polyclonal, which the president just took today, which we'll talk about. But this is a huge breakthrough. If it cuts down the duration in half, you get it in you early. This is just another huge breakthrough in treatments, which in some sense may be more important than vaccine, because the vaccine we'll get it hopefully before the end of the year. Then you got to distribute it. Then you got to get everyone to take it and feel that it's safe. So that's months. If you get a treatment out there that works, like we have the remdesivir, we have the steroids, we have some other things that are being used around the world. But this could certainly be positive, particularly with President Trump, at his age and everything else that he has, having taken this immediately upon getting the symptoms. If he can get through this very, very quickly, I think it would be really, really bullish for the economy. Very obviously, most importantly, key that his health is good and he's back just as a human being. But it would be really, really comforting, because it would give hope to everyone that we finally have a treatment that can just cut this thing in half, which would be amazing. So that's really good news. And we had talked about that as one of the things that was just as important as the vaccine in the information vacuum. The earnings, 69% less companies are issuing negative guidance for this quarter coming up. We're going to start earnings within 2 weeks or less, which is 69% less than average issuing negative guidance. And many companies are taking up their estimates. 2021 earnings estimates for the S&P 500 have gone up. So a lot of good things happening in that information vacuum, but people want to see those earnings in the next couple of weeks, and they want to see the guidance more than anything else. The guidance is going to be key. The third thing was the election. Obviously, the dynamic changed a little bit, today in terms of the key thing here being we need gridlock no matter what the outcome, so that the corporate tax rate doesn't go up. Corporate tax rate goes up, you're going to see earnings come down. The stock market will come down. Now, there was a note out by Goldman that people are confusing this week, saying if it was a blue sweep, it would be fine, because they would make it up with fiscal spending. No matter who's elected, they're going to do an infrastructure package. That's just long overdue. That's number one. But number two is what that note said was by 2024. So you may be of the opinion that it makes sense to make the short-term sacrifice, take a 20-25% revaluation of the stock market lower if you increase the corporate tax rate in the short term, because 4 years from now you can get back to these levels due to the fiscal spending. And, for many people that might make sense in exchange for social reform and that type of thing. But just know what you're buying before you buy it. If you increase the corporate taxes, the stock market will come down. There's just no two ways about it in the intermediate term. That could get changed. It may not take 4 years, because it could get changed back in the midterm elections. But, it wouldn't be changed back, because you'd still have a Democratic president that wouldn't sign a tax cut. So, yeah, it would probably take 4 years per the Goldman note. And then the last thing was the stimulus. So you had the four things of the information vacuum that we're trying to fill on a daily basis: the vaccine, the earnings, the election, and the stimulus. Deal or no deal. And I emphasized higher probability of an executive order than a deal. That might have changed this morning with the president and the first lady's diagnosis, but it remains to be seen. So thank you to Kristen Myers and thank you to Sarah Smith for having me on Wednesday. Really enjoyed that. Moving on, a couple quick quotes in the Wall Street Journal on the 28th. I guess that was Monday. Want to thank Alexander Osipovich and Anna Isaac for including me in their article. And the quote was that, Thomas Hayes, chairman of Great Hill Capital, said his firm bought shares of Wells Fargo and other banks. He expects such stocks to fare better than technology stocks that drove the market's rally from March to September. That's where you're going to outperform with the things that have been left behind so far. Cyclical stocks like banks tend to beat the broader market during recoveries from recessions. And we're going to go into that in more depth. So thank you again to Alexander Osipovich and Anna Isaac. Then on the same day, Devik Jain and Sriyashi Senyal had me in their article. The quote was, "It's the end of the month. Most of the real rebalancing is in the rearview mirror." If you remember, we had that bounce on Friday and Monday. That was a lot of rebalancing because the market had been down so much. They had to regain exposure to equities. And the market has its eyes set on the debate tonight. So this was Tuesday morning for an indication of how policy is going to look in the next 12 months. That's critical as far as what our tax is going to be. We can't belabor that anymore. And the outcome from the debate on Tuesday was, that was just, that was 2 hours I'll never get back. That was tough to watch for both sides. Anyway. So, okay. Then I'd like to thank, thanks again to Devik Jain and Sriyashi Senyal. And finally, an article in the U.S. News and World Report. I'd like to thank Ellen Chang for including me in her article. She writes for the U.S. News and World Report and for TheStreet.com. And her article was about hedging a potential correction in Q4. And I referenced it yesterday because she interviewed me, I think last week for this article that went to print this week. And I said, the market was down materially at that point. It was before the bounce. And I said that the time to buy insurance is before your house goes on fire. We had already had a pretty big correction. That's not to say there's not more to work out, particularly in the overowned tech stocks. But really, there was opportunity. So the quote was, investors who have cash sitting on the sidelines will find that, quote, now is a great time to be selectively picking up laggard stocks in the financials, industrials, materials, and small pockets of energy that will outperform in the early part of the new cycle, says Tom Hayes. Gross domestic product growth of about 6% will occur in 2021 due to the magnitude and the response to the short-term contraction. This is when cyclicals have relative outperformance, and S&P earnings estimates for 2021 support this thesis. Energy, consumer discretionary, financials, and materials will grow at a faster pace than the S&P 500. So re-emphasizing the same theme. And if you've been with me for some time, I've been ahead of the curve on this. We've been pounding the table on this since August, and now it seems that to be consensus because you saw the big money rotation start in the month of September. So for some time, people thought it was going to be impossible to see any money ever come out of FANG, and now it's happening. Now, want to send out our best thoughts and prayers to the First Family, to the President, to the First Lady, Melania, and obviously Barron and extended family, etc. So President Trump was diagnosed with COVID overnight. The market was down big on that in the morning. Then there was talk about a stimulus, and you also had the unemployment rate drop below 8%, as well as talks of a stimulus in the morning. And the market, certainly the Dow wound up flat. S&P and NASDAQ was down pretty materially, and the S&P was down less than that. What was interesting to see, the president's taking, zinc and vitamin D, but the most important thing he's taking was something we put out on Tuesday and we talked about on TV, that this was probably as important as the vaccine was the potentiality of this. It's Lilly and Regeneron's monoclonal antibodies. Today, so effectively what they had was a phase 1 with 275 patients, their symptoms just disappearing after a median of 6 days of receiving a low dose compared with 13 days who took just a placebo. And similarly, only 4.9% of low dose patients required additional medical visits, compared to 7.7 for those who took high dose and 15.2 who took placebo. So 3 times as many people who didn't take it had to go to the hospital. So this could be a breakthrough. And I really think if the president comes out of this very quickly at his age, etc., that this is going to be a major course of treatment and it's going to get through phase 2 and 3 exceptionally quickly. So let's hope it works. Obviously, number one, for the president as a human being, as the president of our country, for our nation, and then for everybody, 330 million people, and then plus around the world who could benefit from his courage to take it early days after just a 275 person study. So this is really courageous and great to see, and maybe really, really good for the whole country. Next, we'll get to our article of the week. I do want to just quickly, because I often forget it at the end, we have our Ask Me Anything question of the week. And this comes from Ben. He says, Tom, if we get a correction in October, would the Russell 2000 and NASDAQ 100 possibly fall the approximate same percent, even though the NASDAQ 100 is approximately 16% above its 200-day moving average, and the Russell is only approximately 4% above its 200-day moving average, since the NASDAQ 100 is heavy growth and the Russell's 2000 is heavy value? So I guess this is a good question. I don't think it... so my answer is not going to be related to how much it's above its 200-day moving average. I think that's less important than just the underlying fundamental thesis. And my general thesis is that it's based on historical data that cyclicals and value outperform in the early stages of a high economic growth environment, which we are entering. And I'll cut a little bit ahead. If you look at the GDP now estimates for third quarter of 2020 is now 34.6% as of yesterday, up from 32% a week ago. So, the economy is recovering extremely quick. And as I referenced on Kristen's show, GDP is going to grow over 6% next year. How do we know that? I mean, nothing's guaranteed, but when you increase M2 money supply 25% year on year, you usually get about a fourth into the real economy. And that would be a reasonable number. And that's when you're going to see cyclicals outperform. So if you did see further pressure in the market in October, it would be overweight pressure in tech and in the over-owned names that everyone's over-concentrated in due to their weightings in the indices relative to those cyclicals where money would start to rotate as managers are sniffing out earnings growth in those fast-growing sectors. As a matter of fact, I'm going to skip around a bit here because it supports the point that Ben is trying to figure out here with his good question this week. Okay, so again, just to reemphasize the earnings growth expectations for 2021, if you look at this chart here, energy is going to be the fastest growing sector. The reason there's no percentage is because they have no earnings this year, but their earnings are negative. But that's understandable when you shut the world down for three months. Then followed by industrials at 87%, consumer discretionary at 74%, materials at 29%, financials at 23%, S&P at just about 26%, and then health technologies down to 13.5%, so half of the S&P. So that's where the pain is going to be, in the lowest earnings growth pockets of over-owned stocks that have pulled a lot of earnings growth forward due to COVID this year. And the other thing that was really interesting that came out today, this is FactSet, by the way, that I'm reading from. It says it actually, but I just want to reemphasize their work. That's really valuable that they put out. Okay, so what they're talking about here, okay, at the company level, the 10 stocks in the S&P 500 with the largest upside and downside differences between their median target price, that's a 12-month target price, and their closing price as of yesterday, October 1st, can be found on the next page. It's interesting to note that the 10 S&P stocks expected to see the largest price increases are all in the energy sector. Now, you can't sell this to anyone right now. Even if you're the guy who can sell ice to an Eskimo, you ain't selling anyone on this story. I'm buying it, but no one else is. But if it takes 2 years instead of 1 year, I'm fine with that. So, but here is the table. So you see, like Diamondback has a target consensus target price of $55. It closed at 29.09 yesterday, so that's an 89% upside. EOG price target 64, closed at 34, upside at 83%. Apache $17 price target, closed at 931, 82% upside. Devon closed at $9, target 16, upside of 75%, and it goes on and on. Holly Frontier target price 32.50, closed at 18.94, 71% upside. Valero, Concho, Schlumberger closed at $15, upside of 24.50, 63 upside. On the flip side, the difference between the bottom 10 were American Airlines. I would take the other side of that trade. Twitter's trading above its price target. Okay, Under Armour. These are stocks actually that their price targets have come down so much that they haven't started re-rating the stock as it's moved up ahead of their depressionary price target. So I'd be less interested in this downside list than I am in the upside list. And as I've said before, you really got to go the top of the food chain on energy, because probably another 20-25% are going to go bankrupt, and you got to have a long-term view. But I do think that certainly we're going to see I think we're going to see a commodity cycle over the next 3 to 5 years. You started to see it a little bit in grains and certainly in copper in the last couple of months, with the dollar weakening, etc. It'll move in fits and starts, but 3 to 5 years out. Plus, you've taken the rig count. Rig count came up a little bit this week, but it's still down, from 1,400 down to 183 or whatever it is since the peak in 2014. And you also have these cuts that are going to go through April of 2022 every single month. And looking at the Chinese trajectory that will follow a few months behind, once we lift the 14-day quarantine for travel, everyone's going to start traveling. I've traveled. Many people have traveled. Everyone wears masks. They got the HEPA filters. It's totally safe. And it's just the quarantine. People can't afford to travel for a week and then have to sit home for 14 days. How are they going to get their kids to school? How are they going to go to their job, etc.? Lift that, you'll see travel bounce back. Oil demand will just go through the roof. And that sector will be back off to the races. Not the same thing. I understand the secular trends and all that, but these things are just priced for death. And when people talk about renewables and everything else, the pace at which the global population and demand growth is rising, we could hit full throttle on renewables, and it would just be enough to offset the population growth in the developing world, so that we wouldn't have to do more fossil fuels. But the idea of doing less fossil fuels in the next 10 to 15 years as the population grows is unrealistic. And if institutions don't want to own them, they're still going to generate that cash. So if they trade at very, very low multiples, they'll just get taken private, and the money will get dividended out to private equity people as the cash flows continue to just pour in a quasi-inflationary environment and demand stability, while more than 25% of the bottom end went bankrupt. So you're going to have less suppliers, equal to greater demand, and global economic growth coming back, all at the same time. You've had these artificial cuts that are going to persist into 2022. It looks well, and this table really, really brings it out. But this is a story that can't be sold right now, so we'll move on to something else. And okay, so thanks again to Ellen. And then so let's move into the Build Me Up Buttercup stock market and sentiment results. This was the article of the week. I love the Mark Twain quote: "October is one of the peculiarly dangerous months to speculate in stocks. The others are January, July, September, April, November, May, March, June, December, August, and February." That was a guy with a sense of humor. So I got the idea for this song this week when my eldest daughter, Mimi, her full name's Madeline, but she will not respond to it, was 2. She's now 8. She'd go into, we'd go drive around, go to the store, whatever. She would just be crying all the time. And one day I had the scan button on where it just bounces from station to station every few seconds until you find something you like. And this song came on, Build Me Up Buttercup. All of a sudden, she just stopped crying. She sat there, she smiled, and she just started, bopping along. So for literally like a year and a half, we had to play this. And the other song she would actually do the same thing to was that Call Me Maybe. I don't know who wrote it, but that's another one. But long story short, the key things, so Build Me Up Buttercup, Don't Break My Heart. So we're talking about the bounce coming into Wednesday and all the setup looking like everyone's very, very confident by Wednesday that when this article was written that the pain in tech is over because it moved, the NASDAQ moved back above its 50-day or whatever it was. And maybe that's the case, but I do think there's probably a little bit more, as we've said in the last couple of weeks, I think there's probably a little bit more for tech to work out and take some of that froth out, and the beneficiaries are going to be cyclicals. So we covered the media spots, again, thanks to Ellie, Cheryl, and Liz, Brad and Francesca, and Kristen and Sarah. Went through that. Now, the reopening trade, we've covered the sectors that are going to grow faster than the S&P, the sectors that are going to grow slower than the S&P in 2020, and the conditions of the reopening trade. Number one, cyclicals outperform in that environment, and the reason that cyclicals start to outperform is that managers have an abundance of choice in where they can buy earnings growth. More companies are providing earnings growth, so managers can then choose from a greater supply. Whereas in a slow growth economic environment, there's a scarcity of companies from which you can buy earnings growth, and that's why you saw the FANG phenomenon, FANG Plus, 5 to 7 stocks where you could see real growth, and everyone had to own them because at sub 2% GDP growth, you're not going to have a huge amount of companies you can choose from where you can get earnings growth at a reasonable price. Now that we're looking forward to 26% S&P growth, 6% GDP growth in 2021 off a low base, now the opportunities become abundant. And when the supply gets bigger, price comes down, and the price for earnings growth is now coming down because you can get into some of these stocks. So the catalyst for the reopening trade is a vaccine or treatment, and that's happening. The reopening, the catalyst for the stay-at-home trade, and those highly priced stocks are shutdowns, lockdowns, and delays in reopening the economy. So we've covered that. The other thing is this table was put out by Ned Davis Research. Ned Davis Research, and it charts from 1932 to the present day the trend of outperformance between value cyclicals and growth tech, basically. But let's just put it between growth and value, low price versus high price stocks, and there's some nuance that goes into that. But historically, with the exception of the last decade, buying stocks at 10 times sales has led to economic disaster. It's worked so far for the last decade. Whether that will persist or not remains to be seen. But the last time you had this decade-plus outperformance of growth relative to value was the 1990s. You can see it here. And what happened after? This is very interesting. This was a report quoted on institutionalinvestor.com, and they were quoting Dimensional Fund Advisors, who was the first shop to really discern these factors and study them over time. But what happened the last time you had this decade-long outperformance of growth relative to value, in 1.5 years, so growth had outperformed value stocks over the 1-year period, 5-year period, 10-year, and even 15 years as of March 31st, 2001. And 1 year later, just 1 year later, the value stocks had regained all of that advantage from 15 years in 1 year. and then the trend resumed down. So while you've had this 10 plus year period like you had in from the late 80s to 2000, 2001, we've had the same thing from, call it 2006, 2007 to now. When it reverses, it can reverse all at once. And maybe September was the first month where effectively the highest weight sectors are going to be less highly weighted, and the lower weight sectors are going to start to be a higher weight in the S&P 500. So it doesn't necessarily mean the indices are going to do poorly. It just means who's going to be winning under the surface is going to change on a relative basis. And that does not mean it's zero sum, that all tech stocks will fail or all energy stocks will succeed. It's certainly not the case. It will just mean that you can now buy high quality franchises that are going to start to have earnings growth. And in the first part of a new cycle, 12 to 24 months, they tend to relatively outperform those sectors that have had their run. So this is a nice visual from Ned Davis Research. Really glad they put that out. And the other thing that I just wanted to get into long-term context here is, as much as you can understand these periodic phases where growth actually outperforms, over the long term, it does not. The long-term return since December 1927 through March 2020 of growth is 9.7% compounded annually since July 1926. The long-term return for value since the same time period is 12.7%. So 300 basis points more. Now you say, well, that's only 3%. Well, 3% is orders of magnitude greater. Why? Well, let's talk about money. So if you had invested $1 in value and $1 in growth in 1927, today the value investment would be worth 18 times more than the growth investment. Okay? So $51,514, that dollar turned into $51,514 if you put it in value. If you put it in growth, it was worth just under $3,000. So $2,922. And by the way, this reminds me of, if you remember, we talked about the performance of the S&P 500 relative to gold. I think it was, if you put $10,000 in gold or the S&P 500 in 1942, by 2018, you had $51 million if you'd invested in the S&P versus $500,000 if you'd invested in gold. So it cost you $51 million to hedge inflation with gold versus hedging it with the pricing power of the top companies in the world as represented by the S&P 500. So this is a similar thing. So in the short term, some of these things have runs and they fake people out and people get overweight. But in the long term, it's, short term is a voting machine, long term is a weighing machine. And the facts are the facts, 18 times. Now you could say, no, the world's changed, because back then they made money, smelting steel and, drilling oil. And we're too high tech now. The CapEx is different. The whole structure of the economy is different. Let's see. You had the Nifty 50 in the 70s and this still played out. You had biotech. You've had these periods of low CapEx businesses. Fundamentally, and some low capex businesses are now value businesses. So I think that once you see the general economy, the GDP growth get back well above 2%, and I think we're going to see 6% next year, you're going to see all of these value and cyclical stocks start to relatively outperform and revert back to the long-term trend line over 100 years. So that is a big deal. Next, I want to shift gears to, this is our 50th video cast. We've got a ton of stuff. So this is an anniversary edition. You're going to get more value for the same price, which is, by the way, the same great price since episode 1, free. So, okay. So in 2002, Spike Lee put out a movie called The 25th Hour, and Edward Norton, one of the great actors, was making a toast in a nightclub, and he said, "Champagne for my real friends and real pain for my sham friends." And, in my single days in my 20s, I was with actually my fiance, now wife at the time, and we were at Bungalow 8, which was a big, big place. Amy Sacco was there, and so was Cameron Diaz. And I made that same toast, and people were blown away as if I had thought of it myself. So I didn't mention that it actually came from the movie. But by the way, the movie stole it from some artist from 100 years ago, so I didn't feel as bad. Nonetheless, it's a great quote, and it's in the context of this sentiment chart, which has made its rounds around the trading community for over a decade, and I saw it pop up this in the last couple of weeks, and I was like, where is that? And I pulled up my old hard drives and I got it, and it was mind-boggling because it just shows this is the same sentiment pattern, whether it's the stock market, an individual sector, or an individual stock. And I've been talking about Wells Fargo for a while. It's one position in a very large portfolio, but it's an important position, and I think it's going to be one of the best ideas I've had in my career if it plays out as anticipated in the next year, 2 years, and it could be much faster. But it was uncanny that this popped up because it's making the exact same pattern as this puzzle. And every time I've had a period in history where I'm like, what's going on? I pulled out this map, and it's been a couple years since I've had to pull it out. I pull it out, and it always fits the puzzle, and it always resolves in this way, when the underlying fundamentals support it. So what this chart is saying is that, stocks get to these points of enthusiasm, then they crash to panic, then they crash more to discouragement, then they monkey around, and then they climb the wall of worry up to anxiety, and then they crash again to aversion, and then they start their climb when no one else believes in the stock again. And I think we're in aversion on a lot of the cyclicals, actually. If you look at ExxonMobil, it's making this exact pattern. If you look at EOG, if you look at PXD, but particularly Wells Fargo is making this to the tick. And as I was actually annotating the Wells Fargo chart, I couldn't believe how perfectly it was following the pattern. So the reason for the quote is real. What I said was Wells Fargo is behaving exactly as it should, causing, quote, real pain to its sham friends, and soon to bring champagne to its real friends. The sham friends are those who bail when the going gets tough, as it's done all this chop building its base down here. And the real friends are those who stick out the tough times and are ultimately going to enjoy a celebration and some champagne. So look at this pattern now. You hit this returning confidence, enthusiasm, subtle warning, overt warning when it broke this. Same thing up here. Then you got the crash into panic, okay? Then you crash lower into discouragement. Here it is again, panic, lower into discouragement. You just muddled around. Then you shot up back again to anxiety. Okay, you got things going right back up to that trend line again. And then you crash down here, and now we're in this aversion. And this aversion has been a prolonged aversion, certainly no fun, this aversion, doing nothing for months. And now it looks like we are moving up from aversion to denial. There will be a shakeout, and then we'll just rocket up to returning confidence, and then we'll be back in enthusiasm, and we'll be lightening up while everyone is starting to get interested in financials. But, and by the way, this is where people will start to buy breakouts after the move has been made, and maybe they'll have a lot more to go. I think these are secular runners because I think they're tied into the housing recovery, and they're going to be an opportunity. So you can keep this hyperlink here and always have a live version so you can track the move from aversion back to denial, back to returning confidence. But I think that's where we are. No one has a perfect crystal ball, but these patterns tend to repeat. And we've already made a huge long-term fundamental case over the last 4 weeks. In our notes, you can click on the Cobra Kai article from last week. And then here's the previous note up here where it says, I think when you take a look at the most hated stock in the S&P 500, we did the most loved versus the most hated stock. We talked about it on Brad Smith's show on Cheddar on September 1st, and also One America with Greta Wall the same day. But these previous notes talk about the fundamental story. So if you guys are like, why is he just talking about charts and sentiment? You'll know that for weeks I did the fundamental story. This is just extra, but it adds a nice flavor on top of it. But if you don't know what you own, all these charts don't mean anything. So you've got to do the work first. And then once you understand the weighing machine, then you can use this kind of stuff to figure out the voting machine. The weighing machine is the long-term result. The voting machine is the short-term manic nature of the stock market, which Benjamin Graham talks about in Buffett's favorite book, The Intelligent Investor. So last week we talked about the leg sweep, and we said that here was support since the crash in March, and basically it did this leg sweep below the volume to take out all the stops, and then it subsequently did a 51% rally in 29 days, and then it came back down to so this was to what? This was to from discouragement to anxiety. And then it crashed right down to aversion. And then it did another leg sweep. It didn't take out the old leg. Did another leg sweep. And now it's back on the run. And actually, it's better than this because this week it was up 1.48%. And it got back above this line, which is really interesting because it's looking very much like this. You had this nice move. So big leg sweep out to take all the stops. Then you had this move up. And then a reversal, move up. And it seems like we're in this range here. And hopefully we start to see this big move like we saw in May. Only this time you would be in not anxiety where it's going to drop back down. You'd be more likely in denial where it's just going to chop a little bit and then resume upward because no one will believe it at that point. And the fundamentals support it. And that would be in line with history. Anytime it's traded at this big of a discount, 38% discount to book, it recovers within months, not within years. That was 2009 and 1992 were the only times that it traded down to this level of discount. And if it ever trades to this level of discount again in my lifetime, I will again be buying hand over fist as we are now. So, so that is the update here. And by the way, what a perfect setup. You swept everyone out, and now we've got earnings coming up where in the last couple of weeks, Moynihan and Shrewsbury of Bank of America and Wells Fargo, outgoing CFO of Wells Fargo, were talking about effectively saying at the Barclays conference that they were over-reserved. And the big four banks are probably over-reserved by about $23 billion due to the accounting change that took place in Q2 due to CECL, which made it look like their earnings dropped $29 billion year over year, when in effect their earning pre-tax only dropped $6 billion year over year if you compared apples to apples with the 2019 accounting standard versus the paper change in 2020, which required them to take 100% of potential expected losses up front. And as we're finding out, at the time that they took those losses, the IMF was saying that the U.S. was going to contract at 12% in 2020, and now it looks like we're going to contract at 3.4 or 3.5%. So it's a huge difference. They thought we were going to be negative in 2021. We're going to grow at 6% in 2021. So all of that $23 billion of excess reserve, credit reserves, will come back on as income in coming quarters as people find out that the losses are much less than anticipated. And if you get another big stimulus package over the weekend or even an executive order, that would go further to assist small businesses and thereby the banks releasing reserves that they over-reserved for in Q2 due to the accounting change. Now, okay, the yield curve steepening is on track. This happens every cycle. The yield curve inverts, and that's what you're seeing right here. We saw last summer, and sure enough, 6 months later, we got a recession. Then it spikes up. This is a steepening. Everyone's focused on short rates and saying, how can banks make money with rates so low? It's not that short rates that they make money on. That's what they are. That's what they are charged for capital, what they lend capital at. So if you take the 10-year spread, the 10-year yield is about over 5x the 2-year yield, and the spread is where they win. And as you see here, the same thing happens every time. This steepens, just like we're seeing here. This steepens, and you see financials, the green line, just take off for secular runs. This inverts, then steepens, you bottom, and then financials run off. If it inverts, you bottom, curve steepens, financials take off. And I think we're going to have a monster secular move, also supported by the unparalleled demand for housing. And keep in mind, if you're skeptical about the housing-led recovery, see 1982. It was the beginning of an 18-year secular bull market in the economy. Why? It was driven by demand from boomers who were starting their housing formation in 82. When you're 60 years old, you don't buy couches and bedrooms and cars and strollers and all that stuff. When you're 30, you buy all that stuff, TVs and, all the stuff that goes in, dishwashers, refrigerators, et cetera, et cetera, et cetera. And that drives the boat. And that's going to drive the boat for the next 10 to 15 years. And we've got, if you thought 82 to 2000 was an incredible time, just imagine that was only with 80 million boomers. We've got 85 million millennials. So this is just beginning, and it's a very good thing. And those taking advantage of bargain prices, generational prices, lows, and some of the high quality, multi-decade, long-term, durable franchises are going to get rewarded hugely. And some of them, by the way, have been raising the dividend every year for the last 10, 20, 30 years on top of it. So every year, not only are you going to buy it at a 20, 30, 40, 50% discount, but you're also going to get a pay raise every single year for the rest of your life. So that's a good thing. Or, next 20, 30 years, whatever, foreseeable future. This shows housing inventories, so it's not only unprecedented demand that's coming, but or already here, but the supply is down to multi-decade lows, not seen since the beginning of the last housing boom, which was from the 2000 recession to 2007. The economic data continues to beat better than expected. We're still well at record highs above anything we've ever seen, even though it came down a little bit to September 30. It's still well above anything we've seen in decades. Sentiment for this week came a little bit up, but most of them are in the mid-range. That's why I think we're still in this kind of rotation churn where I think cyclicals will start to get bid, and I think potentially there's a little bit more to work out on some of the overowned tech and SaaS names. This was, bullish here. It kind of seemed to bottom and sentiment's coming up. So that could be a good thing, but this hasn't hit panic mode yet. So, fear and greed, it was at 45, and then these managers have come down. So yeah, maybe they'll start to chase if the market runs. But again, these are mid-range things. So it's not pound the table. And as I said, 3-4 weeks ago, you're not going to make your money calling the market. You're going to make your money buying laggard sector, high quality in laggard sectors, and you saw that in September, and I think that's going to continue to persist. The reopening trade's going to work, cyclicals trades are going to work, and it'll change day to day. There'll be setbacks. One city or one school will shut down, or some stupid political decision, and then tech will get bid for a day, and everyone will say, "Oh, we're back." And then, but I think the die is cast, and I think September marked the turning point where you'll see relative outperformance. And that's that for the article of the week. Now, if you're on the podcast, we're going to cut off in a minute and a half. We still have a few important things to cover, so you should go on to hedgefundtips.com. There will be the video cast. Just fast forward to minute 60, and then you won't have to replay it unless you want to. You're welcome to. But this is the chart we put out a couple weeks ago on Wells Fargo. It's not only held this level, so basically 15 out of the last 16 times these ADXs crossed, the stock rallied going all the way back, and what happened, it swept below this, and then it closed above. We closed up 1.848% on Wells Fargo this week. So this thesis is still well intact. It was nice to see that. This, again, you have the live link. You can continue to follow it as we likely move from aversion to denial. What do I think is going to be the catalyst at this stage? Look, you could wake up any day and the bank regulators could wake up and say, oh, wait, if we want a sustainable recovery, we need credit growth. Let's take the asset cap off of Wells Fargo. That would make a lot of sense. But you really need the whole group to start to work. And I think you're going to start to see that in earnings within the next few weeks. They're the first group to report earnings. I think the 13th of October, so 11 days from now, I think bank earnings start. You can double check that on the earnings calendar. So that's probably going to be the catalyst. And in the case of Wells Fargo, remember they had $10 billion of costs to take out from all the consultants they were paying. So that will be a huge opportunity to look for the beginnings of that in their earnings, in their Q3 earnings results coming up, and then their forward guidance as to how much more cost they can take out and what happened to loan growth and that type of thing. So I think that's probably the next catalyst if we don't get lucky beforehand and regulators wake up and lift the cap. So this we already went through. This we covered. Value, and you can just see it here, value outperformed growth by 220 basis points in the month of September. That was really good to see. Okay, JP Morgan's Kolanovic. This is Marco, right? Yeah, Marco Kolanovic. I follow this guy. He's been accurate over the years, most of the time. And he put out a note today about the presidential diagnosis of COVID. And he said, in light of recent developments, we are not changing our price targets or outlook across asset classes. Our equity outlook remains positive with a year-end price target of 3,600. Wow. That's, yeah, okay. Sign me up. I mean, I'm ready for that. I'm totally ready for that. So let's hope he's right. But the other thing that he pounds the table on, which is nice to see, maybe he's been listening to our podcast or watching our video cast the last couple of months. He said value will outperform momentum and growth under any election outcome. And he sees this potentially as being a positive thing. And he sees the probability of an early phase 4 stimulus is likely increasing, remain constructive as earnings again come in ahead of expectations and balance sheet trends show further improvement. So that was nice to see. That was actually posted on Zero Hedge. So thanks to those guys for putting out that excerpts from that research note. And then more this week, we just saw huge blocks of institutional size option buys coming into banks. This one was a couple of days ago in a Brazilian bank, Banco Bradesco, 30,000 contracts in the March 2021 $3 calls. That was a huge buy. Then we saw 9,900 contracts in Citi today, out to 2022, 6250 strike. And then we saw a monster. By the way, this was like one of 3 blocks, but this was a almost 26,000 contract block for Wells Fargo for December 30 calls. So they're expecting the type of catalyst that we're looking for from earnings or maybe some other good luck beforehand. But that was a big buy recent, and maybe it's one of the institutions listening to this podcast. But anyway, I hope they make a lot of money because that means we will too. And that was that. We covered that. And then lastly is just some of the economic beating data this week. It's just been phenomenal. We had on Tuesday was that consumer confidence number. Expectation was 89.2. It came in at 101.8, up from 86.3. The consumer's coming back in a major way. Then the API, you got to draw. We covered that in June. Once those cuts went into place, we were going to move from builds to draws, and we've done that effectively every single week ever since. And this week we had a draw of 2 million barrels relative to 1.98 relative to 1.56 expectations. Also, manufacturing PMI, the Purchasing Managers Index in Chicago crushed expectations. 52 came in at 62.4. Pending home sales up 8.8%. Again, a beat. The ADP report we covered. It was nice to see that huge amount of manufacturing jobs added. And moving on to yesterday, continuing claims is really the most important number. It continues to come down every single week. And then today we got the unemployment rate below 8%, which no one was looking for. We talked about it on Kristen's show and on Cheryl's on the Claimant Countdown. So that was nice to see that coming in. New payrolls, private were a little less than expected because of the government census jobs rolled off. So it's not as bad as it looks actually, but that's where the hit came in there. And then the rig count actually went up a little bit, which should hopefully start to help some of the largest oil servicers among the likes of maybe the Halliburton and Schlumberger. And then Michigan, all the consumer numbers for Michigan beat consumer expectations. Consumer sentiment was 80.4 versus 79. And current conditions. So that was all very, very positive as far as the economic data. So want to thank you. Some of you I know have been with me since the first episode. Here we are at episode 50. Stick with me. If you thought the first 50 were incredible, wait till we get to episode 100. It's going to knock your socks off. But in the meantime, I want to wish you a great weekend. Thanks for listening in. We'll be back next week, same time, same place. Make it a great one.